What's up, everyone? It's me here. So yesterday, after the market closed, China shook markets to their very core when they announced that they sold a whopping 15% of their US Treasury holdings while simultaneously buying over 300 tons of gold. And no, this isn't some sort of weird joke or an April Fool's Day prank, because these are moves that haven't been seen since 2009. But with China now selling nearly $180 billion worth of U.S. treasuries in the last 3 months alone, it's important that we break down exactly what this means, why they are redoing it, and then finally how this could impact your investments during a time where everything is already going down in price. Although before we start, as usual, if you appreciate videos like this that take me dozens of hours to research and make, it would mean a lot to me if you hit the like button or subscribed if you haven't done that already. That's it. Thank you so much, and now let's begin. Alright, so first, when it comes to China's massive $170 billion move. It all began earlier this year when Xi Jinping pledged to promote the use of the renminbi in international transactions, effectively saying that they want to get away from using dollars. In terms of just how much of an impact this is having on the global economy, here's where things get interesting. As Bloomberg reports, China's dumping of U.S. treasuries and the simultaneous increase in its gold holdings suggest Beijing may be shifting towards a more independent monetary policy, which could have global repercussions. China has reduced its holdings of U.S. debt by about 15% in the past 3 months, to the lowest level since at least 2009. It also boosted its gold reserves by the most since 2015. To quote directly, a reduction of such magnitude has only happened during the global financial crisis and the Eurozone debt crisis, said Nathan Sheets, head of global economics research at Citigroup Incorporated in New York. It does appear to reflect a move away from dollarization of international transactions. Now, seeing as China makes up 20% of the entire global economy, this has naturally caused quite the stir throughout the markets. After all, who doesn't love a good old-fashioned crisis? But when it comes to exactly what's happening, we got to start with China's official statements. With the People's Bank of China coming out and saying that the sale of U.S. treasuries was part of a normal adjustment of its portfolio in light of changes in the domestic and international economic environment. In other words, they claim that this is just a natural reallocation of assets as their own economy evolves. On top of that, the Chinese government also noted that the recent sellings were minor compared to the overall scale of their holdings, which, is true when you consider that they still hold on to a hefty $834 billion worth of treasuries even after selling another $29 billion in March. However, when you take into account that this marks 13 straight months of net selling for the Chinese, it begins to paint a slightly different picture. On top of that, the timing really couldn't be any worse, with Treasury Secretary Janet Yellen visiting Beijing in an attempt to de-risk the United States and China's intertwined economies. Not to mention the ongoing trade war with the United States, increased tensions with Taiwan, and a slowing global economy. These are conditions that have led many experts to believe that China's selling is actually a coordinated effort to weaken the dollar and promote the use of their currency instead. For example, Rabobank analysts wrote in a note that China's efforts to internationalize the yuan are likely contributing to its declining treasury holdings. A key component of those efforts has been a push by Beijing to expand the use of the yuan in cross-border trade settlements, which has indeed shown a positive trend recently. In fact, the Wall Street Journal reported that settlement of Chinese goods with the yuan rose to 46.9% in March from 41.8% a year earlier. According to data from the Society for Worldwide Interbank Financial Telecommunication. For China, the more they're able to use their own currency, the less they need to rely on the United States dollar. And from their perspective, it makes sense to reduce their holdings when they have no imminent need to tap those funds. That's why when you look beyond just the United States, you'll see that Chinese holdings of all foreign assets fell in February by the most in almost 2 decades. In addition to that, China's Foreign Ministry spokesman Wang Wenbin stated that China firmly safeguards national security and the safety of its overseas assets. This is in response to sanctions imposed by the United States, which China views as a violation of market rules and the basic norms of international relations. It's pretty clear that there's a bit of retaliation involved here, too. The problem, though, is that China's actions could be the catalyst that sends everything else into a tailspin, too. Just think about it. If China sells off more treasuries, the demand for them will go down, which will cause prices to drop and yields to increase. This is actually a concept known as a liquidity drain, which is essentially when investors sell their bonds back to the treasury in order to get cash instead. Although in this case, it's China's sales that are taking place in the open market, which creates downward pressure on prices. Now, it should be said that the impact from this alone is unlikely to send shockwaves throughout the market, but it doesn't help that China is also now buying gold. Just last month, the country added 331 tons of gold to its reserves, the most since December of 2015, bringing the total to a record 675 tons of gold held in reserve. Because of this, gold is once again on track to become the best performing asset of the last decade. Even better than that, according to economist Sultan Passer, the combination of China's treasury sales and gold purchases suggests that Beijing is preparing for deflation, which is exactly what we've been talking about in our weekly newsletters. Now, when it comes to the overall impact of China's moves, not everyone believes that this is something worth worrying about. For instance, one strategist noted that China's gold purchases might be a way of rebalancing their portfolios rather than a bet against the dollar. Either way, the combination of rising interest rates and quantitative tightening is starting to have an effect on the value of bonds. And it's likely that China recognizes this. However, others like Paul Krugman argue that the sellings are a sign of weakness within the Chinese economy. And that China's slowdown is being caused by both global events as well as their own policy mistakes. As far as my own thoughts on this situation, I tend to agree with the notion that China is diversifying their holdings to reduce their reliance on the United States dollar. However, I think it's also true that the growth within their economy is starting to slow down. Because of that, I wouldn't be surprised if their treasuries continued to shrink in size, while their gold and commodity purchases continued to grow in size. After all, if you look back throughout history, this is typically the type of behavior we see right before an economic downturn. Not to mention the last time China ramped up their gold buying was right before the 2008 crash. However, on the other hand, there is also reason to believe that the worst could be yet to come as global demand for treasury securities is set to decline by 50% this year. On top of that, the International Monetary Fund warned that global financial conditions have tightened significantly in the past year, with tighter credit conditions expected to weigh heavily on global GDP growth in 2023 and 2024. In other words, although the future remains uncertain, it seems that we'll continue to see more selling as investors seek safer forms of capital, which in theory could send yields even higher. Overall, though, I do think this is something that most people have to worry about unless you have a ton of money and are relying on the value of treasuries to stay high. But just in case you don't have hundreds of millions of dollars sitting around, I think the more important news is that new unemployment claims have risen and continue to head higher. In a situation where more people are filing for unemployment, there is a greater chance that the Fed will pause or lower interest rates to help stimulate the economy. Of course, that would send bond values higher, which is good news if you own them. And so that's what's going on in the markets today. Like I mentioned, this is something that is more of a concern if you're a large investor looking to buy treasuries. But otherwise, I wouldn't expect this to have any significant impact on the average investor unless you invest in precious metals. That's why if you're interested in learning more about our recent gold purchase, feel free to check out this video next. So with that said, you guys, thank you so much for watching. Also, make sure to subscribe. Hit the like button. Add me on social media. Those are the best ways to stay updated with me. I'll see you in the next video.